A very good morning to every one of you, dear friends. My name, as you know, is Dr. Rajendra Prasad Sharma, and I am Professor of Marketing at Indian Institute of Foreign Trade. In today's video session, I am going to discuss with you a very potent technique of pricing, and that is break-even analysis and target return pricing. In my earlier session, I have already shared with you how pricing is important as a marketing mix element. This price is known by several names. It's the price which is so flexibly operating in the entire business domain in such a way that it contributes the maximum to the top line and bottom line results of a company. Today we are going to be focusing on how businesses can use break-even analysis. So we will try to look at what is this break-even analysis. And then we are also going to look at the target return pricing, because your pricing should be such that you make a profit. So let me start explaining, basically the fact that break even actually means that you should recover your costs. Yeah, your volume of production should be such, your pricing should be such, your costs should be taken care of. So break-even analysis is alternatively also referred as cost volume profit analysis. So when any enterprise, when it undertakes to carry out any business, there are associated costs. Which costs? There are certain costs that vary with the level of production, scale of production, every unit you produce. So every chapati, that every braid, every soap that a manufacturing plant manufactures, there is some raw material, some variable cost which goes into production. So that could be the direct material cost. Yeah, so it is attributed to that particular unit of production. So if I make one more jacket, or if I make one more pen, so one more refill will go into it, one more body will go into it. So the component cost and all that is actually the variable cost. So I must recover that direct material cost of the variable cost, which varies with every single unit of operation production. Businesses also have certain costs which are overhead costs. They are called fixed costs. So whether you operate at lower capacity or full capacity or no capacity, still there is a cost that you have to pay. So during the corona crisis, many retailers operating in the malls, they had to pay the rent. Many organizations had to pay the salaries. Such costs are fixed costs. So you must recover your fixed cost, you must recover your variable cost. Fixed cost is irrespective of the volume of production, and that is why it is called fixed. So it remains fixed. You will have to incur that cost. You must absorb that cost when you price your products. So cost volume profit analysis is an alternative name, as I said, for break-even analysis. For I said, drawing from the principles of economics, because pricing theory is basically microeconomics if you have an idea. Microeconomics is also known as theory of the firm or pricing theory. So in this theory, what happens is that there is a marginal incremental principle that applies. So with every unit of production, you have to incur a cost, and that's the marginal cost. With every additional incremental unit of sales unit, you get a marginal revenue. And if you multiply your price with the total quantity that you sell, quantity multiplied by price is your TR, total revenue. So let us understand both the revenue as well as costs. Why I'm talking about revenues also simultaneously? Because if you have only costs and no revenue, you are not in business. Businesses have to incur costs. But when you sell your product at certain price, whatever volume that you sell, that's going to be your total revenue. So in business terminology, this refers to turnover, sales revenue, right? And revenue, total revenue minus total cost is the total profit, is the profit. So ideally, every firm has to price in such a way that there is a surplus left with the business organization for undertaking this activity of carrying the operations. And that is the essence of understanding costs as well as revenues. So friends, break-even analysis and target return pricing are two important ways which can help us in assessing how firms can be successful in their mission, their objectives of profitability and profit making. Let us take one of these at a time. So I am going to start with break-even analysis. It breaks even. So break-even, simply stated, is that level at which a firm neither makes a profit nor makes a loss. So it is that price, the price at which whatever quantity that you sell is absorbing all your costs. Which costs? I have already talked about the fixed cost and the variable cost. So basically the total cost. So the total cost is in sync with the total revenue. TC is equivalent to TR, and that is the break-even point. So if my total revenue is lesser than, so if my volume of sales is lesser because my price is higher or whatever reason, then I am not recovering my costs and I am making losses. So that is a zone of losses. In the graph, this can be depicted properly. On the y-axis, we denote the revenue or the costs in terms of the price. On the x-axis, we can talk about the quantity, the volume, the manufacturing volume, the sales volume. So break-even point is that point where a certain quantity at certain price is leading to a no loss, no profit situation. However, businesses are meant for making profits, and therefore this guides that a business must make a decision where it maximizes its total revenue. Yeah, or at least I must price in a way, even in the short run, that I at least recover my variable costs. And in the long run, successfully, we should be meeting our profit objectives. And profit objectives are always targeted by the businesses, and that is also pointing towards the second important aspect which I am going to discuss with you soon, is target return pricing. Now, to make this understandable in a better way, I would like to take a case of a Floor Cover Limited, a company. And this company is in the business of making floor covers, which can be changed, which can be replaced. And these floor covers are nothing but plastic covers. So the question is, how would the company set the price of a floor cover? So already the company is manufacturing a range of floor cover which requires changing every year. Every year it requires to be changed. And the company is selling it at 38 rupees per square yard. Ex works means from their factory. If you need packing and forwarding to be done, you have to pay extra 2 rupees. If you want installation at your premises, you need to pay another rupees 4 per square yard for installation. So the company extends the service also. So to the customer, the price is rupees 38 plus 2 plus 4 per square yard, which is 44 rupees per square yard. Now, with great research and development, this company has come up with a more durable, stain-free, a different plasto cover, which is, so value proposition is there. You are creating value, you are solving customer problems. It is stain-free. If tea, coffee falls in it, it is washable. And this floor cover doesn't require changing every year. And the target market, the segment that the company chooses, is B2B market, commercial establishments. Say airlines, Emirates and Air India and Indigo and such airlines. And primarily the market is that they are looking at is maybe domestic and international markets, a mixture of the two. So with this kind of a product, which the company has manufactured after a lot of research and development, the key issue is to find out what is my break-even point price, what is my break-even volume, what is my cost volume profit, what is the kind of return that I can aspire. So therefore, again, using what we have discussed so far, we would like to look at the cost components again. As I said, there's a variable cost and there is a fixed cost. So that will lead to the total cost. So on the cost part, the details are something like this. That for manufacturing 100 square yards of floor cover, the company requires fiberglass, and that costs you about 50 rupees per square yard. Now 50 rupees per square yard fiberglass is a direct material cost that enters into every yard of production of the floor cover that you get into. All right. And then for every 100 square yards, you also require 60 rupees of adhesive. So per square yard, it will be 60 paisa. Yeah, 50 rupees per square yard is already the fiberglass cost. Adhesive rupees 60 for 100 square yards. And then comes the direct labor, which is 270. So 270 rupees direct labor cost. So labor means you are paying wages as your, for producing 100 square yards, your labor cost is this much. Now that has been calculated because hours of labor per hour wages, daily wages, you have taken that into consideration. Now this is your variable cost. You can compute your total variable cost in terms of per square yard for this particular product. But then there are other costs also, as I said, fixed costs. So I'm giving details about them. That, supervision cost the company 4,500 rupees per month, inspection cost 330 rupees per month, factory rent is 2,400 per month, other expenses are 240 rupees per month, material cutting machine purchased at 1,800 rupees with a service life of 10 years, so that needs to be computed as fixed cost because it's a capital expenditure. And all these building tables, okay, where you actually do the operation, they are also an asset that you have, and they have a service life of 5 years. So some capital expenditure items have a life of 10 years, some have life of 5 years. You know the principle of depreciation. So you have to calculate that per month, what is the fixed cost of your overheads. And selling and administration is 15,000 rupees per month, which is inclusive of 9,000 advertising expenditure. So friends, total production capacity that the plant has is 2,400 square yards. Now using these figures, we are trying to compute what is the fixed cost that we have. So the fixed cost in our case is the supervision cost, the inspection cost, the miscellaneous cost, the factory rent, the other costs, the selling and admin. These are all fixed costs. Highest fixed cost component is selling and admin cost only, administration. So, and this is coming to 23,010. In fact, depreciation cost is also part of the fixed cost. So the material which will be depreciating, the fixed assets which will be depreciating, which ones, like the 3 building tables and the material cutting machines, and counting the depreciation on them with service life of 10 years and 15 years, you get a figure that depreciation cost per annum is going to be 1,260. And per month is going to be divided by 12, so 105, which also needs to be added to that cost. Which one? That 23,010. So 23,115 is the fixed cost, and the variable cost is the fiberglass, as I said, 50 rupees, adhesive I said 60 paisa, 60 rupees, okay, so only 60 paisa per square yard, and direct labor is 2 rupees 70 paisa per square yard because 270 is for 100 yards. So you get variable cost per unit, which is 53 rupees 30 paisa. Now we have calculated our variable cost 53 rupees 30 paisa. We have calculated our fixed cost, which is 23,115 rupees per month, come what may, irrespective of whatever volume of production, you will have to incur that kind of a cost. So therefore, what volume should the factory operate, particularly when you know that your total capacity is 2,400 if you operate at full capacity, 100%. So now we have to make a pricing decision using break-even point analysis. And this break-even point analysis will let you know as to what will be the right quantity with which you should proceed in terms of manufacturing or seeking orders, because marketing is all about getting orders, not only about manufacturing. You cannot make pricing decision if you do not really do break-even analysis, because otherwise you will only look at, because your fixed cost needs to be apportioned over total volume. So it can be, any price, because you got a good play to operate. If you operate at full capacity, your per unit cost is going to be low. That is the principle which we are going to be looking into. So basically, if you produce whatever number of units, since you know that 53 rupees 30 paisa is your variable cost, since you know your fixed cost 323,115, then you have to see that the price at which you sell and the quantity that you sell should be higher than the cost that you incur. Therefore, the break-even quantity for Floor Cover Limited for this new plastic cover is calculated at 405 square yards. How has this been calculated? 405 square yards is what you need to manufacture if you sell this at 110 rupees 50 paisa. Okay, so if you price it lower, then you have to sell a higher quantity. If you price it still higher, then you can still break even at a lower quantity. A volume of just 300 units you can break even at. So ideally you can price anywhere. As I told you, the customer might be willing to pay a higher price because I said the new floor cover is 5 times better and more durable as compared to the earlier one. Therefore, understanding break-even analysis and the capacity utilization is a very, very interesting and an important area. 25% capacity utilization, 50% capacity utilization, or 100% capacity utilization, or you decide that. And you know the life, you know the installation charges, everything. So break-even analysis, friends, helps you in making an appropriate decision about pricing. So let us try to calculate break-even here. And the formula for break-even. So the formula for break-even is that the fixed cost, which is 23115 in case of our example, needs to be divided by the price that you charge minus the variable cost. So the price minus variable cost is your contribution margin. Per unit contribution margin. What is your per unit contribution margin? If you sell at 120 rupees, your per unit contribution margin can be low. But if you sell at 150 rupees, your per unit contribution margin will be very high. So your break-even point will be lesser number of units, as I have been telling you. Understanding this break-even analysis is important. So as part of the pricing determination methods, many firms also look at target return pricing. And in target return pricing, there is an expectation of return by the owner of the firm, by the promoters of the firm. Okay, the shareholders expect some kind of a dividend. So when the entrepreneurs are looking at certain kind of a return, because even the cost of capital is say 10% in the market, then you pay salaries to the people, you take risks, and you need to, take care of a lot of other costs. So there's a target return that people expect from their businesses. Okay, and this target return, suppose the target return is 30%. then 30% return you need on your invested capital. So invested capital is suppose 500 crores. So you want 30% of 500 crores, which means 150 crore is my target return. Yep, divided by the expected unit of sales. And I add unit cost to that. So the formula for target return pricing is that once you have calculated your unit cost of one unit, the marginal cost, then you can simply look at that I am expecting 20%, 25% or 30% return, multiply that with the total investment that you made and divide that by the expected sales. That gives you the target return and it helps you in pricing. Let us clarify this with the help of an example. And the example is that suppose target pricing is what you are supposed trying to do. And if the unit price is 16 rupees, and if you are expecting 20% return, and if your invested capital is about a million, 10 lakhs, then 16 plus 0.2 multiplied by 10 lakhs divided by 50,000. So 16 plus, this becomes 2 lakhs divided by 50,000, which means 16 plus 4, which means that if you price your product at 20, price rupees 20, then you get 20% target return. And this is how it guides you. So basically, friends, target return pricing helps you make that profit. So if a firm which has made certain investment, they decide that we need to make a profit of 5 lakhs or 5 crores, in that case, they will know precisely that to get that kind of a profit, how many units they have to sell, what is supposed to be their target return in that case. And they look at all components of the cost as well as the investment and the fixed cost. This is very, very important, without which all our calculations are going to be haywire. Understanding of break-even cost and target return pricing helps businesses take care of their costs and not make losses, avoid losses, and get into the profit zone, recover the costs, and meet the expectations of the business promoters. That is the sole objective of the calculation. So I hope it has been pretty clear to you, each one of you. We have taken an example also, which is again like a caselet. You can relate with it. You can find your own examples also. That businesses must meet all their costs, all their overheads from their prices, and strike a balance and calculate that at certain price, what is going to be my break-even point. And if you know that volume, and if your capacity is limited, and if you are operating full capacity, then in that case you can even calculate that what will be my break-even price at which I'll be breaking even, and then look at the target return pricing. So with that, I hope the concepts are pretty clear to you. Hope you enjoyed listening to me. Uh, Thank you so much. Look forward to seeing you with more sessions on pricing. Yeah, pricing is very important.